Hi, this is Rick Rodriguez with Fairway Independent Mortgage Corporation, one of the branch sales managers here and also a certified reverse mortgage professional. And I'm going to show you in today's video how a reverse mortgage compares to a traditional mortgage in three different options or three different ways in which you can use the reverse mortgage. And what you have here in front of you is our presentation software that we use to present to clients and also to financial planners and other professionals. And in this scenario that I'm going to show you, we have here an individual who is 73 years of age, has a current mortgage of $410,000, making principal and interest payments each month of $1,666. This is their interest rate that they obtained, and the remaining months on their traditional mortgage. Essentially, they just took out this mortgage here in the last few months. And what I'm going to show you is how a reverse mortgage compares side by side to a traditional mortgage. And in option number one, or presentation number one, we're going to show how the reverse mortgage can increase one's liquidity by not having to make a mortgage payment. Because if you don't know, a reverse mortgage is an optional mortgage payment. You can make payments like a traditional mortgage and actually treat your reverse mortgage like a traditional mortgage, but the benefit of it is that you also have the ability to not make mortgage payments. And if you don't, that's perfectly fine with the reverse mortgage. And this scenario here, we have three tanks in our presentation. We have a savings tank, a borrowed tank, which represents the mortgage liability, the mortgage balance that is owed. And then in the house tank here, this represents the value of the home as well as the equity in the home. On the left side, we have the traditional mortgage. On the right side here, we have the reverse mortgage, which is the FHA reverse mortgage. And the technical term of an FHA reverse mortgage is a HECM, which stands for Home Equity Conversion Mortgage. So we're going to see now, over time, if you pay attention here, the starting point of this example is someone who's age 73. And if you pay attention to the three tanks on both sides, the savings tank, the mortgage balance tank, and the equity tank, and how they change as we go up in years. In other words, as this homeowner ages over time, how these three tanks are going to react. And I'm going to take this up 10 years, and then I'm going to pause there, and we're going to look at the difference. So here we go. As you'll see, numbers are going to start changing. Now, why is there a line of credit amount here in the reverse mortgage, as you can see here? Well, that's because one of the benefits of a reverse mortgage is after we pay off the existing mortgage, there could be additional equity that one has access to, in which one of the options on how they can take out that equity is through a reverse mortgage line of credit, which is very similar to a home equity line of credit, however, a bit superior because of how it works. And one of the aspects of it that's different from a HELOC is that it's a growing line of credit, meaning that for however long you have your reverse mortgage, and as long as you have a positive balance in that line of credit and interest rates are positive, of course, your line of credit is insured by the product to grow every month and every year. And this is irregardless of what your home's value is doing, irregardless of what the markets may be doing. This is all based on the interest rate of the product. So as you will see, that line of credit amount is going to increase as we continue going over time. And also, if you notice down here, this difference in cash flow, and what this represents down here, this is how much this individual has saved in mortgage payments up to this point. We're right now at the age of 77. And that is, again, the $1,666 per month of principal and interest multiplied by 12. That's $20,000 per year that this person would have been making towards a traditional mortgage in the form of payments versus the reverse mortgage. So we've gone up 4 years. This is why 4 times 20,000, we're already at an 80,000 positive cash flow for the reverse mortgage. I'm going to continue on up until the age of 83, 10 years into the loan. Okay. And there we go. So 10 years into the loan on the traditional mortgage, the balance, of course, has been reduced from where it started at 410,000. It's now at 304. And by making those payments, of course, home equity has gone up. However, this person did not have any savings or nest egg, and during these 10 years hasn't been able to contribute to the savings tank. So this is why the liquidity is still showing 0. On the other side, with the reverse mortgage, as I mentioned, this line of credit here has been increasing over time from where it started. And these are funds that are available for use at any point in time. You don't have to be reapproved for it. It's liquid and on standby to be used whenever you need it. The process is quite quick, quite simple. You send in your requests, and in a matter of 3 to 5 business days, the funds that you've requested from your line of credit get direct deposited into your personal account. So in this example here, 10 years in, this person has a reverse mortgage line of credit of $51,712. Also down here, the big difference is over that same time, 10 years, they've been able to save approximately $200,000 in mortgage payments. This is cash that they've been able to retain in their pocket, and perhaps they might have deposited it into the savings bucket, which we're going to see in the next example. Or maybe they've used it for other purposes, pay off other debt, personal use, what have you. There's no restrictions, obviously, on what one can use their funds for. But the point is that at this point in time, 10 years in, this person has $51,712 plus $200,000, approximately $251,000 and change in additional cash flow than if they would have continued with the traditional mortgage. Now, home equity is not as much because the mortgage balance, since they haven't made any payments, the mortgage balance has gone up. So therefore, the equity is not as great. However, cash, liquidity, is what we're focusing on here in this example. So this is example number 1. Now, let me take you to example number 2. And that is going to be showing what if instead of making payments to the mortgage of $1,666, what if we were, or this person, I should say, were to make payments towards their savings account, their nest egg, and we're using an average rate of return of 5%. And so in this next scenario I'm going to show you, we're going to see again the tanks and how they react and change in this second scenario with someone making the payments towards their savings, their nest egg, instead of a mortgage. Okay, and here's the side-by-side, same numbers that we started with. If you notice, starting balance here on the existing mortgage, $410,000. Starting balance here on the reverse mortgage, $437,000. Line of credit at day 1 is $30,000. So now what I want you to pay attention here is, again, the savings account bucket over here with the reverse mortgage. And you're going to see this increasing because now with the reverse mortgage, payments are going right into the savings retirement account. And pay attention again here, the ages. I'm going to start stepping up. I'm going to stop at age 83 once again, just to keep it in line with our last comparison. Here we go. All right. We're moving up. we're moving up, 78, 79, 80, 81, 82, and 83. We're going to rest here. 10 years in. So now what? So this person, we're same balances here. If you remember from the last example, they owe 304,000. They have this much in equity. Home is worth this much. Now with the reverse mortgage, you notice the line of credit's the same, $51,712. The balance is the same. The equity is the same as in this last example. But the big difference now is liquidity. And now total liquidity, $310,515. That's a representation of the line of credit, $51,712, plus a savings that they've been able to accumulate of $258,803, which represents, again, the mortgage payments that they're now redirecting. Instead of going towards a mortgage and real estate, they're redirecting that cash flow to their nest egg, to their savings accounts, again, earning an average rate of return of 5% over this time. So in this example here, showing how, again, with the optional payment feature of the reverse mortgage, how you can now take that cash, create greater liquidity, greater savings by having the reverse mortgage option. We're going to go through one more option here. And that would be, what if instead of making these payments here, $1,666 towards your savings, what if we made those payments directly to the reverse mortgage? Because again, as I mentioned earlier, it's an optional payment mortgage, so you can make payments if you'd like. So in this third example, now this person is going to make the mortgage payments instead of to the traditional mortgage, to the reverse mortgage. And we're going to see, what is the difference? How is this going to, how are the three tanks going to react? And keep, again, a close eye on the savings tanks here. Also, you're going to notice on the reverse mortgage balance tank, you're going to see this balance start going down instead of the two previous examples where the balance was going up. You're going to see that balance go up, go down. You're also going to see home equity go up. All right, here we go. 75, 76, just stepping up in the ages. 78, I'm going to stop at 83. Again, 10 years in. All right, here we are, age 83. What has happened? These are the same numbers, if you notice, from the previous two scenarios that we went through on the existing mortgage side, on the left side. Now, on the reverse mortgage side, the right side, what has happened? Well, as you can see, the amount that they owe has come down. It's less than in the previous two examples. $485,000 they owe on the reverse mortgage side, as compared to the traditional mortgage side, they owe $304,000. What about home equity? $1,143,000. Not as high as it is on the traditional mortgage, but pretty comparative. What's the big difference? Liquidity. The line of credit has now increased to $315,987. Why has that reverse mortgage line of credit increased so much? Because when you make payments towards your reverse mortgage, those payments not only reduce the balance that you owe, but those payments increase your reverse mortgage line of credit dollar for dollar. And on top of that, as I mentioned earlier, you have the growth component of the line, which is growing at the same interest rate as the mortgage balance is growing. So in this scenario, this person, by making payments towards a reverse mortgage instead of traditional mortgage, have given themselves the ability to keep that money in hand, those mortgage payments, in other words, in hand in liquidity, so that if they needed to reaccess this money for any reason at all with a reverse mortgage, you can do that. And you can remain more liquid in retirement than with the traditional mortgage, where you're not increasing your liquidity your nest egg, your savings, by making payments to the traditional mortgage. Sure, equity is increasing, but not your liquidity. So this is option number 3, how you can make payments towards your reverse mortgage to, again, accomplish what? A greater savings. And by having a greater savings and having more liquidity, what does that equate to for someone? Well, a more successful retirement. And that is what a reverse mortgage strives to do, is to provide not only more options, more flexibility, but in general, a more successful retirement. If you've got any questions on this, if you'd like to see a specific scenario for you or your loved one, or anyone that perhaps is a client of yours or you work with, reach out to me anytime. Happy to do this. We are trying to change how retirement is done in this country. And unfortunately, home equity is not being utilized enough to be able to provide a greater assurance of a more successful retirement. Again, Rick Rodriguez with Fha Reverse Mortgage, and look forward to hearing from you. Talk to you soon.